I will now turn the presentation over to Carla Zevnik-Seisler, President of ClearStep Financial, with offices located in Wisconsin and Minneapolis. Go ahead, Carla.
Thank you, Dave. Our team here at ClearStep Financial is glad you could join us on this special discussion regarding the TUG strategies and the markets. Our guest speaker today is Thomas Campbell. Thomas Campbell is a devoted advocate of tactical active management, which is TUG, and utilizes this approach with the TUG strategy, which can be found. We use it in both the Schwab and the Q3 asset management accounts. On a personal note,
doing your webinar?
I am.
Hold on, everyone, just a minute. Okay. On a personal note, Thomas is married with 2 children, loves family, church, golf, and home schooling, and resides in Texas. And we've been working with Thomas Campbell for many, many years. So we trust and appreciate him and what he brings to the table. So it is my pleasure to introduce Thomas. He will start with initially current financial markets, and then he'll get into some of the TUG strategies and how it works. So thanks, Thomas, for being with us today.
You're welcome. I will, so I'll begin with hopefully sharing my screen, if I can figure out how to do that. If Dave or somebody can help me is that. So what I want to begin with is kind of where we are from a market perspective. Obviously, this is a very different year than 2022. And I want to kind of walk through a little bit about, we have been consistently, and I mean by we, STF Management has been consistently telling advisors, including ClearStep advisors, that you need to be fully invested this year. That again, what follows a midterm election year is generally a banner year. And so the average decline in a midterm election year is about 16, 17%. The average recovery over the next 12 months is in the 30% range. And we've certainly seen that. But in this case, I am still, Dave, there we go. Start my video. Is that right? And now that's not doing it.
And then share at the bottom.
Yeah, I'm clicking on share at the bottom, but it doesn't let me pick Dave. It doesn't let me pick. It's grayed out. The word share is when I pick Windows, Chrome tab, entire screen. I can't click the other share component of it. Okay. You can unfortunately see me, which is not what I was hoping for. Face for radio.
We're getting it going here, Thomas. We have our #1 tech guy, Nathan, working on it. So we're getting it going. Yep.
Yep.
Okay, so he said it should work. Try it now.
All right. Click on share screen. And again, I'm not, I still see a grayed out share button. Whether I'm clicking on Chrome tab window or the entire screen, which what I'd like to do is the entire screen, I'm not getting that. Why is this the case? Let me try something here. More.
Yes.
No, that's not it either. Close that. This is me and Zoom. Settings.
Yeah, because I can share.
Yeah, right. Exactly. And I can tell you more or less what to get going. It's going to be the harder part. It's going to be some of the files that are going to be more interesting, right? Video.
Yeah, or it's Thomas that isn't able to.
Okay, Nathan said it's Thomas.
He said it's me. I love it. I love it. That is funny. All right. Yeah. So
What you're looking to share, Thomas, is it a PowerPoint or a PDF or what?
It's a series of PDFs. So and then it's on financeyahoo.com, which I can walk you through. So give me a second and I will email this stuff to you, Dave. And then you can, or Carla, I'll send it to both of you guys and then we can go from there.
Okay.
I'm going to give it to Carla. No.
Yep.
I apologize for this too, because like I said, I even know where the share stuff is for a change, which is always exciting to me. All right, send that. So there, I sent you three. I sent you 3 PDFs, and Carla, if you'll go out to financeyahoo.com, we'll start with that.
Okay.
So as you guys know, I always, if anybody asks me how is TUG doing, what's TUG doing, I always pull up a chart of the NASDAQ 100 on financeyahoo.com. And I basically, start with a couple of a 1 year picture and a couple of moving averages, the 50 and the 200-day moving average. So if we can get that going, then we'll have that to start with.
All right, we're working on it. We'll have it
Okay.
right up.
That is so frustrating. Okay.
Fortunately, we've got the ability to shift, just like the markets. This is
Right.
what happens with the markets and with the strategies that we work with as well. They have to be able to maneuver and shift through the uncertain aspects.
Exactly. Adaptive. So over there under quotes, go and type in the quote lookup. You can type, or right there, caret NDX. The shift 6. There we go, right there. The NASDAQ 100, second one. Yep, perfect. Now, when this comes up, we see where it says chart underneath summary chart conversation. Click on chart, please. Scroll down, click on 1 year. Perfect. Now, over on the indicators, please. Go ahead and put in a moving average. Type in save for there. 50 is fine. And then go for indicators again. And this time put in 200. And change the color to something other than purple. Find out what Carla's favorite color is here.
Nathan's favorite color.
Nathan's favorite color. Okay, great. Excellent. All right, great. So Nathan, if you'll kind of pull that up just a little bit and get rid of that experience, our best charts ever, get that garbage off of there and scroll that just a little bit so we can kind of see a little bit toward the bottom of it. No, don't do, okay, that's fine. Yeah, I was gonna say, yeah, that'll work. Oh, now see if you change it, then you'll lose the. So just click 1 year again, and it'll reset the parameters. Perfect. All right, excellent. All right, good. So this is I'm going back to February and March because again, this was the tell for us from this perspective to sit there and say we need to be as invested as possible in 2023 because again we're coming off of a midterm election. The following 12 months is always much better, and obviously 2023 is a post midterm election year. But the turning point occurred here when you see this convergence in February and March, as you see the 50-day moving average moving up to the 200-day moving average, and the market is above both of those things, and then you have that conjunction of the market and the moving averages all happening at the same time. Again, because the moving averages came into it with the market above, the next 12 months, the markets never failed to produce a better return. So we, at that moment in time, said, hey, guys, it is time to get involved in this, and this thing is off to the races and going. What became interesting to us was the market ran into June and then had a little bit of weakness there. There was some volatility. And in fact, the TUG system reacted to that. So our ETFs went to a 50-50 position at that time. The SMAs stayed long and benefited with that until that July 19th high that you see that peak in the middle of the chart. From there, things didn't turn out like we had expected. You do expect to have some weakness in the August, September sort of a time frame. However, things that were generally expecting to be support didn't turn out to be support. Nathan, I don't know if you can draw a line, but if you see where it says that little pencil over on the far right-hand side, click there and see where it go over a little bit more toward July, where you see that the big dip in the June-July period of the market. Oh, yeah. So now you have to hit escape because once you start, it'll keep drawing. So there you go. So see the dip between June and July? Yes, right there. Perfect. Click there. And then draw that line straight across. That's good. Click it right now, straight across. So it hits those bottoms. Perfect. Right there. Excellent. So pull that out and now move your cursor off the screen to the far right. Excellent. It's gone now. Now, what we were looking at here this was one of the kind of the original things that we were going off and saying, okay, we expect that if this market pulls back, the 50-day moving average would hopefully be support. You can see that in August, the market broke through the 50-day moving average and then actually found the 50 to be resistance and support kind of in August and September. But for us, the bottom line was really that June, July low, and we expected it to hold. And in fact, at the end of August, beginning of September, it did in fact hold. Interestingly enough, we retested that again in September, but it failed, and it dropped to that purple line that we see. It recovered back to that point, dropped again, and then recovered, and then fell back a third time, recovered a bit, and so all of a sudden we're in this very tight range, and then the market failed essentially at the end of October. This was that last little move that you see there as the market's heading down to its 200-day moving average was where the TUG ETFs went back to 50-50 and were 50-50 for literally just about a little bit a week at most. And then you see that the market took off, and November was one of the best months in the NASDAQ in a long time, and certainly the best month that we had in 2023. So we had some interesting chop through the middle of this. What was happening during this period of time was we have been expecting the Federal Reserve to basically say no to interest rate hikes, that at some level they're going to declare victory. And going back to the only historical analog that we have, 1981, 1982, 82 was a pre-election year. Markets fell apart. However, they had started raising interest rates in 81. And so coming into 82, in the August-September timeframe, they were able to, quote unquote, declare victory. And the market took off just like it did here in November. What's interesting is, again, in that first 2 months of 1982, the market jumped 30-something%. It would be more than half of what you would get in returns over the next 12 months. So if you weren't in the market at the very beginning of that move up, then you kind of missed most of it from that perspective. So this is why it was important for us, and I felt really good about the TUG system basically going right back into 100% long, even with that little bit of a dip there at the end of October into the beginning of November, and we've remained at that level since. But now, Nathan, if you were to go off and draw a line from that July peak and then off to the right, you can use purple again if you want to. So just right there, that one, and then straight over to the right, you'll notice that we're basically at what? That same value. Okay, so click there. That's fine. So you can see that, again, the market's been capped a little bit. So I don't know if this is a digestion phase or if the market is now, in fact, waiting for the Federal Reserve to come out and sit there and say, we really, truly are not going to raise interest rates. Now, my hope is that they come out and say, we're not going to raise interest rates. And, oh, by the way, we're not going to lower them. Because, again, when they start to lower interest rates, that is in a response to what? Weakening, really, truly weakening employment and really, truly weakening economic environment. So my hope is that they are not in a position to have to do that in 2024. I've talked about this in the past with you guys, but I will remind you that there are 3 threats to the stock market. And the first is valuation. The second is economic. The third is political. So let's eliminate the valuation argument right now. Yes, the Schiller people and some other people came out in the end of October and basically sat there and said, look, this market, the S&P 500 needs to be 3,200 or less, which is a big decline from where we are. And they're basically saying, what? If I look at 100 years worth of stock market data, this market's overbought. That's garbage. Because, again, we're still, relatively speaking, at the bottom of the interest rate range. Yes, I know 7% 30-year fixed mortgages seem really high when most of us probably have 3 or less. But the reality of the situation is that is not high historically. And so the discounting mechanisms and things like this, I don't think are being fully accounted for in that regard. Second, there's just a boatload of cash on the sidelines. The amount of money sitting in money market accounts is at record levels. And so this valuation, that you keep hearing about people saying, "Oh, the market's overvalued or maybe fairly valued," really that doesn't carry a lot of weight with me, because at the end of the day, the value of something's what some other idiot is willing to pay for it, nothing more, nothing less. So if you don't like Apple stock, then you don't think it's worth $3 trillion. If you think it is a good company, then it is worth $3 trillion, and there's no metric based on that sort of perception component that really makes sense to me. So generally speaking, leave the valuations aside. Onto the economic, we've been talking about this. Right now, the economy is still growing. Employment situation is good. Inflation is coming down. The Federal Reserve has not raised rates recently. They keep threatening us with it, but they have not actually done it. Europe, the Bank of England and other places are seeing inflation coming in. And so there's not been a raise of rates per se over in those areas as well. And so there's this conversation. We saw it again this morning in the news of we haven't seen the full impact, even in some cases. So there's a belief, I think, of the status quo. As long as the inflation trends continue moving in the right direction, as long as employment doesn't get overcooked, then there's no reason for the Federal Reserve or any other central bank to raise rates, which means the economy should settle into kind of a working position. If the economy is not the threat, then the real threat is on the political side of the house. And again, I will go off and sit there and say this is where I think the economy, the Fed, and politics all combine together. There was a article that was done within the last 6 months that basically showed that the Federal Reserve is essentially, when you look at them, is leftist Democrat. God bless you if you're one, and God bless you if you're not. That's not the point of this. It is to sit there and say that you need to understand this. It is not the Federal Reserve chair people or voting members that tend to be leftists. It is all the way down to the janitors in the organization. The entire organization is bent on that left-hand side of the fulcrum. And there's no way that they're going to continue to raise rates and ensure an economic situation, and then say to a incumbent Democrat and an incumbent Senate, you have to go win a national election in 2024. Because at the end of the day, whatever people sit there and say about single, issue voters, the larger the deciding factor, the independents almost always end up voting on their pocketbook. So throw out the basically well balanced Republican and Democratic votes, and if you look at for what an independent is going to go off and prioritize, generally speaking, they prioritize household item kinds of realities. And if the Federal Reserve has generated a recession next year as people come into the election cycle, that is a tough hill for anybody to win. Again, go back to George H.W. Bush. Let's reverse the political calculus here. George H.W. Bush, very, very popular president, over 90% approval rating in 1991, loses the election in 1992 because the economy is soft. It is just a cold reality of the fact that the middle part of the country is going to vote its pocketbook. And so I think this is another thing that will keep the Federal Reserve from doing something stupid to interfere, kind of quote unquote, with the market from that perspective. If that is the case, then our forecast for 2024 should be a prototypical election year cycle. And you would say to me, well, 2016 and 2020 were not prototypical. And the answer is absolutely not. In 2016, we had the worst opening to the market in January ever. And yet the year ended up positive at the end. But it was 10 months or so of just very, very choppy, awful market conditions and a surprise at the end. 2020, again, another election year, very, very strange. Obviously, we started off with COVID in the late February, March into April timeframe, and a big loss, but then big recovery with massive amounts of volatility coming into the election, and not much afterward. So November, December were relatively muted returns from that perspective. I would think we have a more prototypical year in the sense that I would expect to see us get to highs in the market in the mid-January or so timeframe, weakness into March, strength April and May, weakness into Labor Day, and then strength from Labor Day to the end of the year. So that would be the typical year, and I wouldn't be surprised again if we have another double-digit, total return for the S&P 500 in that environment. Given that we won't have, I'm hoping we don't have any exogenous events like something happening in Taiwan, an expansion of what's happening in Ukraine and Russia, or something very untoward happening in the Middle East. So that's kind of where we are. This is kind of where I think we're going, and the things to take a look at. I believe our risks next year are going to center around the political side of the house. So with that, I would like to get into kind of how are we reacting to some of these things, and what are we doing from a TUG perspective. So if I could get you, Carlett or Nathan, to go into the STF Management Q4 2023 PDF, and then go down to page 6, please. And while we're waiting on this, this is we're going to look at just a handful of pages here. So bounce down to page 6 if you don't mind. Thank you. Perfect. Excellent. And so what this is our performance at the end of the third quarter. And kind of what I want to go off and focus on is sort of the year-to-date numbers versus the benchmarks. Okay, and I want to basically point out, just a couple of things. One, the benchmark for us in this case is a 70% of the total return of the NASDAQ 100 and 30% of the Bloomberg U.S. Aggregate Bond Complex. And we're showing a year-to-date, benchmark of 23.47%. And you can see TUG at the top at 24.44. And so we're right in line with what we would expect to have over that period of time. We definitely were using bonds. We used them at the very beginning of the year, January, February. We used them again at in the July and August period of time. We used them for the last time again at the very end of October, beginning of November. So we have been in 50-50 positions. And so even with our having essentially 4 months out of 9, having some bond position, we've kept up with our benchmark just fine. And then when you look at the TUG end value, you'll notice that there is a difference, 24.4 versus 21.8. The difference there, of course, is what? We've distributed this year through the end of this week, we've distributed almost 11% of the NAV as dividends. So again, our dividend side of the house has been very, very strong. And the delta between these two, which is about 2.6%, is really good. As a comparison, if you want to see how efficient we're being with our income component, take a look and do a comparison sometime. And I was going to do this for you of QYLD and its NAV versus QQQ year to date. And there's a 20% difference. And that's because their options program, the way that their options program works, even though it generates really nice options returns, it is a real drag on the system because they've been holding puts to protect a market that hasn't fallen apart. And so it's this active options program that we have with TUG plus our active asset allocation that we think gives us a better risk return and volatility perspective. To which point, I'd like us to bounce down to page 12 and take a look at some of our volatility statistics real quick. So when you get here, again, this is where we are looking at, at the end of September, how are we doing from a volatility perspective versus, other things? And you can see on the far right-hand side, there's the NASDAQ 100. Yeah, it's having a tremendous year, but it's obviously been, over the last 12 months, has been quite a volatile period of time. And then notice that to the left of that is a 70-30 portfolio, and just to the right of the TUG figure is the 60/40 portfolio. Well, that 70/30 portfolio is the standard definition of what I want to do for somebody who's kind of a moderate, growth sort of an investor. So it's essentially our benchmark, if that makes sense, right? And notice that that's running at 19 and we're running at 14. Well, that's a 30% increase in volatility over what we are exhibiting. And so again, we're showing you less volatility and we're still giving you what? All those returns. Go to the next page, please. Page 13. So over here, then, how is our yield? How does our yield compare to things? Well, again, now you start on the far left-hand side. What's the yield on a 70/30 portfolio? It's still less than 3%. On a 60/40 portfolio, it's just over 3%. We're running nearly at 12. So again, we have a better yield complex than you even get with a high yield bond fund, a junk fund, if that makes sense, right? Emerging market debt, again, sometimes hardly better than junk status in those cases. But even when you look at things like MLPs and REITs, which are the alternatives that most people think about, I want to get out of the stock market and I'd like to get into an oil and gas lease, or I'd like to get into some sort of a real estate, an apartment complex, a office building, a medical memory care place, blah, blah, blah. And these things have good coupons. Well, yeah, they do. You're looking at a much stronger return than you are getting with other things. But again, nothing like you're getting with TUG. So our last slide on this one is then let's put these things together. Am I getting paid for my volatility? So page 14, please.
So Thomas, if I can interrupt here for a minute. So TUG-N is a newer version of TUG. So there's 4 different types of TUGs. TUGs are based on NASDAQ 100. In the past, you've always said NASDAQ 100 is the purest index, meaning that there are 100 stocks, 8 different sectors, very technology focused, but they're very diverse sectors all over the United States. But it's a pure index. But if you can touch upon that, and then the TUG-N is a newer version of TUG, and you've always said TUG-N or TUG plus income is designed for dividends and for the ability when you're in retirement to be able to generate, maybe it's an alternative to stock dividends. A lot of people go into stocks to get dividends, but if you can touch upon TUG-N too, that would be great.
Fantastic. Yeah. So this is what, so I'm going to stay on TUG-N here for just a second and wrap this up. And then I'll get into the differences between, you can see we highlight 2 different ETFs here, TUG-N at the top and TUG down at the bottom. So the TUG at the bottom has been our very traditional approach. And so we're going to call that the TUG that runs in these separately managed accounts. There's 3 versions of this. There's a TUG 0, which is our most conservative. We take no leverage. We take no inverse positions. And again, it's a mixture of the NASDAQ 100 and government fixed income positions. There's a TUG 1, which allows us to go symmetrically long and short the NASDAQ 100. But we only go short in bear markets. And then there's a TUG 2 component. TUG 2 allows us to go double long the NASDAQ in strong bull market situations. So like in November, TUG 2 makes 15% in a single month. Why? Well, because the NASDAQ did so well and TUG captured 75% of that big move up. So these are the SMAs. Now, there's a 4th separately managed account called TUG plus income. It is essentially a combination of the 2 gray boxes with the little orange dotted lines around them. We take TUG-N, the income component is 70% weighting, and then the other 30% is essentially just that bottom version of TUG, except in this case, we're not using the ETF, we use the mutual fund QAITX. Now, what we're doing with that is to say we want to give to the client and the advisor the ability to do what? To generate some income in their portfolio apart from dividends in stocks or yield in bonds. Those are the only ways that you can generate income. I get a dividend from a company like an Exxon or a Chevron. I get a yield because I loaned my money to a government entity, or a corporation. And the problem with all of those things is that as again, you can see right here, this chart is full of all of those different options. And so if I think about a high yield bond, that top line, yeah, I've got a good yield. It's almost 9%, but my volatility is relatively high compared to that. And so, but equal. And so I get like this very good yield to volatility ratio, right? Emerging market debt, same thing. TUG-N, which is not generating its yield in that same way, has a very nice combination as well, 0.85. Now, the difference between the high yield bonds and emerging market debts is one, I'm not having to worry about currency exchange with emerging market debt. And two, high yield bonds are very much tied to the stock market. Meaning, if you go and take a look at like a 2000 through 2002 or 2007, 8, 9, high yield bonds fall with not because of interest rates, but because of corporate safety, if that makes sense. If I've got a company that's now firing people, pulling back from R&D, it's in a kind of a regression mode. Those bonds lose their value, and sometimes it can be quite dramatic. We saw moments here in when oil was dropping below $10 a barrel, and then its spot price, its open market price was negative something for a little while. The bonds attached to oil and gas were selling for 20 cents on the dollar. So yes, I've got a great yield, but now the bond itself is worthless. And so these things can have very high volatilities at times. And what we're trying to do with TUG is we're showing you we keep our volatility low because we're managing the interior component in the way that we manage the rest of the TUGs. So now putting this all together, again, our comparison is to go off and take a look at that 70-30 mix, which is just above the TUG, and to sit there and say, look, we are giving you in just the flat out owning the NASDAQ 100 and its yield component, or the bond plus NASDAQ component that we've had over this last year, we've nearly matched a yield and volatility return that you get from a 70-30 mixture with just the TUG product. So this is the strength of this. So what's nice about having all four of these to play with is now I'm in a position to say to myself, all right, I would like to have a 30% weighting of this TUG plus income in my portfolio at all time, because why? It generates a yield, and let's say it's 2.5%, and I have an appropriate exposure to the NASDAQ 100 and to fixed income as necessary as these markets change and as I need to adapt to them. What's nice about that 30% weighting in my portfolios is I've covered all the management fees of anything for anybody who's going. I mean, 2.5% covers more than enough of management fees for everybody's portfolio. It covers it covers the fees to the advisor. It covers, by and large, it even covers most of the underlying sub account fees. And so, having something like that, who doesn't even want to take the income, generates the cash that pays for the fees for the portfolio for the year, as well as then does what? Generates capital returns on top of it. So that fourth bucket is really something that's quite fun to go off and play with. And frankly, people who are using the TUG 0 and the TUG 1 would be better off with TUG plus income, because again, the rules of the ETF are slightly different than the SMA, which is where I want to go now with the presentation into the white paper, please, the TUG white paper PDF. Back in June, as you guys know, the ETFs went to a 50-50 position, and they did so because there was that little bit of volatility that we looked at in the chart at the end of June into July. And TUG responds to internal volatility of price by basically saying, hey, something's going on. We need to take and move into our fixed income side of the house. However, I had a question, I thought a profound question from somebody. He's like going, but why are you doing that? Because the market's going up. And I know that sounds pretty simple and straightforward, but it is profound in this sense. As you know, June of last year, we ditched our fundamental bottoms-up bond approach in favor of just simply picking the least correlated government duration to the NASDAQ 100. So as interest rates were rising, we were no longer in the long duration notes. We were in the short duration, so 1 to 3 years and stuff like this. And we really realized that, you know what, we don't have, and we probably will not have, an environment where that old bond strategy is going to work, because we should be entering kind of a new regime. We're at the end of this big bond bull market that we noted from 1982 all the way into, say, let's say call 2020, when the 30-year note basically at one moment in time reached 0.87%. And from that moment in time, the 30-year note's only been going in one direction, up. Well, if we're in this new regime, then we needed to make an adaptation. Our adaptation was to focus strictly on just duration. So if we need fixed income, we look at the longest duration that has the least correlation to the market. But we still left in our system this door that opened us up to that type of old bond system. We loved it. We wanted to use it whenever we could. It gave us such great results. Why would we not try to get involved in it when we saw any kind of volatility in the NASDAQ 100? But we jettisoned it. So it's essentially like having a door in your house that opens into nothing. I mean, there's no room, there's no outside, it's just a door that goes nowhere. And this was the response that I had when I heard the question in June to why did you move because of volatility? Well, the reality is that, again, TUG only looks at the market. It doesn't look at any context. It's just the price of those 103 stocks. This is, to Carla's point, this is why I love the NASDAQ. It's pure Darwinism. You grow in, you grow out. There's nobody basically, with their finger on the balance trying to sit there and say one stock versus another. And so from that perspective, I get no context as to why the market's pricing these stocks the way that they are. The bond system used to give us that, because the bond system didn't care about the price of bonds. It only cared about the inputs that should reflect in the price of those bonds. And so that was the mismatch that we experienced back in 2022. But now I have a system that has no context at all. I'm just looking at the price of the NASDAQ. I'm just looking at the price of bonds. I'm looking at correlation. There's no context. And so what we did in July was we brought context back into the system. At the end of July, we brought context back into the system by looking at the VIX. So instead of an internal measurement of volatility, we now look at an external volatility measure that's everybody's looking at, which is called the VIX. Here's how it works for us essentially. If we see weakness in the market like we saw, that we saw here in that July high, and then August, September, October, we just kind of saw that stair step down. As the market kept failing at different levels, one of the things we noted was that people were not buying insurance or protection against a bigger down move in the market. What does that mean? Well, that's what the VIX measures. The VIX measures kind of a put to call ratio. And what that means is the people who are buying puts are basically saying, I think this market's going to fall apart 10, 15, 20%. So I want to buy insurance against that. Well, the more that there are puts being added into the system, the more people believe that there's implied future volatility. And yet all through the summer, that volatility measure never got very high, never really got above 20, except for one little spike at the end. And you saw that little break at the end of October. That was the only time the VIX spiked up above 20. And that was the first time that TUG decided it needed to take some action, because now, quote unquote, the smart money people are taking and buying insurance on their portfolio. Now, all of a sudden, we have what? Back in our system? Context. What's nice about this is by adding that back into our system, we eliminated a whole bunch more trades, and we are more persistent in our positions than we've ever been before. And the result is what I'm going to share with you here first on this updated white paper. So if you don't mind, let's go over to page 4, please. Page 5, unfortunately, because I forget the first page is the cover. There we go. I don't know if you can make this chart bigger, but let's start with the bottom half of the 20 worst, if you don't mind. Now, the setup of this white paper, of course, is as follows. Over the last 15 years, if you missed the best and worst days of the market, you actually get the stock market's returns. But what anybody ever shares with you as a client or as an advisor is what happens if you miss the 10 best? What happens if you miss the 20 best? And therefore, the result is you have to always be a buy and hold investor. You have to let asset allocation do its wonders. And what we're saying with TUG is, well, what if I could get rid of all my exposure to the best and worst days? If I could tactically avoid the moments in time that drive me the most nuts. Because again, your client's watching the market take off 7%, going, why are we in the market? Well, it's because the market's down 30%. I mean, why would you called me up a week ago because the market dropped 5% one day. So it's these moments of time when you see these 40 dates that the market's at its most extreme. It is driving you emotionally crazy. And if I could tell you, you don't have to worry about these emotionally crazy days, then guess what? You should allow the system to do its work and you're going to get to the promised land. Well, let's look at those 20 worst days. Notice that of the 20 days that are the worst, we're only partially exposed to 5 of them. But notice the dates. They're all in 2020. Now, if you scroll up and take a look at the top, the 20 best days, you'll note that 10 of them were long. And again, in all of those, most of those actually also occur in 2020. But interestingly enough, we are obviously far more exposed to better days than we are to negative days. If I strip out the 2020s from both sides, then guess what? Notice we are never involved in any of the dates in 2008 or 2009. What's the difference? Well, the difference is that TUG can recognize a bear market, 2007, 8, 9, versus a bear market correction, the first quarter of 2020. And in a bear market, you want to be where? Someplace else. Yeah, the market's going to go up and down a ton, but you don't even want to be involved in it because it's just random. It's the thing that literally drives you the most nuts. The fear of being wiped out, the fear of missing out. But in a bear market correction, you want to do what? Yeah, I'm going to reduce my risk 50-50, but I'm going to hold through that period of time because why? It's just a correction in a larger bull market. And TUG absolutely responds in those ways. The result of this, guys, is the following. If I were running a back test, and again, we're not talking about the income side of the house. We're just talking about the ETF. So TUG, T-U-G, the ETF. Over the last 25 years, it should give you 4 times the return of the NASDAQ 100 with 1/4 the maximum drawdown. It is a big advantage over what we've had in the past, simply because we're doing what? We're being more persistent in our trades. We're trading less times, and we're making the trades more appropriate. So this work that was done here recently, I think is a big lift to us. And like I said, the only thing we've seen trading on it recently was just that little bit October. It moved because of the VIX. As soon as the VIX cleared, we moved right back into the market. And so we see quicker, better, I think, trades and more appropriate positioning holding when we need to through volatility, which then leads to the last PDF, which is, again, nothing that you guys can share, but something I just wanted to walk you through, which is what does that 4th version of TUG look like from kind of a historical perspective? This is what's been missing in our conversations with you guys. And so this was something that we were able to provide to Q3, and they were able to generate a fully back-tested version of the 70-30 mix of TUG-N and QAITX. And again, this is where, for myself, if I'm not using TUG2, this is the version that I'm going to use because of its yield component and its risk component. Now I'm in this position down here again to get a very simple average return of 12%, and that is before any yield on this because there's no yield component in this. And again, you can sit there and take a look and say what my maximum drawdown is that in that 20% range. Again, most of that is coming from the QAITX because it's still using the old SMA rules and it's still using the old SMA bond components to it. But again, this is a very solid system, so a very solid rate of return. If you go take a look at what happened in 2022 with this, so if you scroll down just a bit.
So Thomas, just if I can interrupt a minute here, then just to clarify, so you're showing TUG plus income. TUG is one of you're comparing that with like a 70-40 mix, 70-40, 70% equity. I'm sorry, 70-30, 30%
Yeah.
bond mix is what you're comparing it with, correct?
That's right. Exactly
And-
right.
And TUG plus income is in a Q3 portfolio.
Yep.
So what you're saying is this past summer, you changed the ability to measure risk, which is volatility. So
Correct.
the newer TUG plus income version is actually less volatile than
Yes.
the history of this account for 25 years. So
Exactly.
this is pretty darn good, right? This is pretty darn good. The old
Yep.
model of TUG plus income is pretty darn good, but the newer version as of this July with less volatility so what's the maximum drawdown in the newer version of the TUG?
So the newer version of TUG's maximum drawdown is back in the 17% range.
Okay.
Yep. So now we take a look at this, and again, guys, this is fully back tested. So again, take a look at what you would have seen. Again, 21% in 2022. That still sounds horrifying, right? However, not horrifying to people who actually invested in TUG in 2022, right? Because at the end of the day, 30% of this portfolio still cannot escape the fact that it's got to be invested in what? Fixed income. 70% of this portfolio is still invested in short duration bonds, which still lost money in 2022. So in an environment, this goes back to one of Carla's earlier points, the how would you call it? The behavior, the characteristic of TUG still remains the same. You take a look at a 2015 where bonds and stocks aren't doing anything. Well, you get a kind of a flat rate, minus 2%. 2016, bonds and stocks aren't doing anything. You get a kind of a flat rate, minus 1.1%. Both bonds and stocks are getting hammered in 2022. You see your maximum drawdown. There's the laydown. There's the drawdown expectations that you have with TUG. All of that's perfectly preserved, but these numbers are much more meeting our expectations of reality. I'm not coughing up 40% or 30% of the portfolio. I'm coughing up a more reasonable 20% of the portfolio. Does that help?
Yes.
All right, perfect.
Thank you.
You're welcome.
What
Go
would
ahead.
you recommend, Thomas? So someone who is more of a moderate investor, doesn't want to see a whole lot of volatility in their account, but wants to have the ability to grow and have some preservation. What percent mix do you see the TUG plus income?
So TUG plus income in my mind is a core component because again, it represents the two core assets to any, generally well-constructed portfolio, which is some equity and some bonds, right? And so for me, I'm generally telling people 25 to 35% of the portfolio can be TUG plus income. Now, whether you add any more TUG to it or not really depends on what you think is going to happen with equities. Like in my case, I have felt and I have said consistently, I believe that once we got through the summer months, the doldrums, which I thought would end in September, that we would see the market rally based on the Fed, coming off and saying, "Hey, we're more or less done. We are declaring victory." And so I added to my portfolios my 30% exposure of TUG plus income. I added to my portfolio a 30%, 35% exposure to TUG 2. Now, what that gave me was an opportunity to tell my clients that if this market runs, I've got what 35% in TUG 2, which is double on the NASDAQ. So that's 70% exposure. And if TUG plus income is 100% exposed, I have 100% exposure of my portfolio to the NASDAQ 100, which means I have 30% of my portfolio, or in this case, actually 35% of my portfolio that I can do what? I can hedge. I can use a mean reversion strategy like Bull Cipher, the new Bull Cipher. I can use a asset allocation program that gets me other asset classes like Voyage. I can try and pick a sector strategy like SA or EA. And I've got 35% of my portfolio to play with, knowing that the other, two combinations of TUG 2 and TUG plus income give me 100% exposure to the index that I think is going to win. So those are the dynamics that are in my mind as I'm building these portfolios. And so I will probably always keep a hefty component of my portfolios, 25 to 35, will always be in TUG plus income. And then I will probably always have some mean reversion strategy. So that's the bull cipher. I will probably always have some voyage, simply because it has the exposure to alternative asset classes. And then the rest is, now I'm sitting down talking with my client. How do you feel about the markets? How do you feel about your ability to absorb risk? What is your maximum drawdown values that you're looking for? And then building in the appropriate other elements to that.
So Thomas, so two questions. Number one, would you be able to explain why you feel confident with the NASDAQ 100 index, which is what TUG is based on?
Yes. So at the end of the day, so we have four major indices in the United States: the Dow, the S&P, the Russell, and the Nasdaq 100. In the case of the Dow, the S&P, and the Russell, they are all made up by committees of smart people, either meeting in Chicago or New York, deciding what we should invest in. The Dow 30, as an example, generally speaking, is almost always sort of very, very backwards looking. And I just go through this historical component of you just to kind of give you a sample of what happens with the S&P and the Russell. In 1998, when oil dropped below $10 a barrel, they kicked Chevron out of the Dow 30 stocks. They replaced it with a chip manufacturing company called Intel. Intel's stock has never been as high as it was in the late 1990s. 25 years later, it's basically been dead money the whole time. But it was the first NASDAQ stock that they added to the Dow 30. You kind of go through and you move forward. And so now it's 2005, 2006. They added a fifth financial services firm to the Dow because financial stocks did so well through 2000 through 2002, because that was a tech wreck, which destroyed the NASDAQ 100 down 82%. Well, the Dow people were like, well, we don't want to add any more of these crazy NASDAQ stocks to it, but we do like these financial companies, and they added AIG to the Dow. Well, how did that work out, right? And so it's these kinds of decisions that sort of drive me nuts about stuff. Let's talk about the S&P 500 and two stocks that you may be familiar with. One is Facebook, and the other one is Tesla. Facebook comes out and IPOs on the Nasdaq. It's a disaster. It's so oversubscribed. Everybody wants to get a piece of it. I mean, the Nasdaq systems could not handle the volume, couldn't handle all the banging, et cetera, et cetera. It just is it's a flat out disaster. And the stock drops. It doesn't pop in any way, shape, or form. Nobody can honestly tell you what the pricing is on it. It's really a goose egg from the Nasdaq website and functionality and systems, et cetera, et cetera. But the next time they rebalance the Nasdaq 100, it's such a large company, it is automatically included in the Nasdaq 100. Again, nobody is banging the table going, this is going to be one of the top 5 companies in the world. It happens because why? That's the process. It's again, there's no human involvement. Just we scan the top 100 companies, you're in or you're out. And Facebook is in. And then all of a sudden it takes off, right? A year and a half later, and it is still one of the top 5 market cap valued stocks, and it's one of the best performing stocks in 2023. But again, not because anybody said it was, just simply because it is. Now, the opposite of Facebook is Twitter. Now, not the Elon Musk Twitter, but the original version of Twitter. They look at what happened on the NASDAQ. They say, well, we're going to go on the NYSE. So the NYSE goes off and launches, and it does a great job. It pops. The stock is awesome, blah, blah, blah. And the S&P 500 people, because they know this is going to be such a big stock, are like, we're going to change our rules and allow Twitter to come in, even though it doesn't have any profits, it hasn't reported any profits, blah, blah, blah. And they include it immediately into the S&P 500. The stock has been crap ever since. I mean, and it's not gotten any better since Musk bought it. And why did they do that? Because they didn't want to see what happened with Facebook and the NASDAQ. So they went off and they bent their rules for Twitter, and that was a disaster. Now, same thing happened with Tesla. The S&P 500 famously never let Tesla into the S&P 500, even though it's I mean, they sell more electric vehicles than anybody else, and they sell them far cheaper than anybody else. They have the only charging infrastructure in the world, et cetera, et cetera. Why is it not in the S&P 500? Because they don't make any money. They're not profitable. And so it's not until it's the fourth largest company in the world and it's generated 2/4 of profits because of its offsets, its carbon offsets, that they finally let it into the S&P 500. It's that kind of stupidity that drives me nuts about these other three indices. And so for me, why the NASDAQ 100 is the base of this. Again, you go over any period of time, over the last 10 years rolling period, over the last 20 years rolling period, over the last 25 years rolling period, the NASDAQ 100 is always leading. Why? Because all of these indices are based on survivor bias, and the NASDAQ is built on it. And so that's why I believe in the NASDAQ 100 more than anything else. That help?
Yep, that's great, Thomas. So the NASDAQ is it is a pure index. It's not based on committee or stupidity, like you said, decision-making processes that don't necessarily make sense. So these other indexes are hard to count on, whereas this one is, like I said, a pure index. Either you're in or out.
Yep. So what other questions do we have?
So if someone is, and I alluded to this, but I think this is another good point. One of the reasons why you formulated TUG-N, TUG plus income, TUG-N, it's really the similar strategy, is because so many people, what they'll do in retirement is they'll go for the stock dividend stocks, or they'll go dividend paying stocks, or there's strategies that they'll go to for that. And if you can explain a little bit of why that was formulated as a new TUG position, Thomas.
Yeah, exactly. So at the end of the day, I think there are kind of three things that I believe you really need to keep in mind. So we had a mutual fund version of TUG. That's the QAITX mutual fund. The problem with the mutual fund or the separately managed account, the SMAs, is that every time you make a trade inside of it, it is a buy and a sell from the IRS's perspective. And so all of us as advisors and all of us as clients we get at the end of the year a giant 1099-B with all of the trades, and you have to account for all this stuff. And it's very lovely that Axos and E-Trade and Trust Company and whatnot have always provided that information for us so we can go off and handle it. But at the end of the day, it's still a whopping impact on the client. So in 2020, TUG is up 30 something percent, and anybody in a non-qualified account has to recognize all of those gains as ordinary income. So one of the first things we wanted to do is to say, can we make this much more tax efficient? And the fact is that the laws surrounding ETFs allow for a greater level of tax efficiency. We've made 3 or 4 trades, depending on how you look at it, in TUG this year, our 2 ETFs, TUG and TUG-N. In our underlying, we've made 3 or 4 trades, but at the end of the year, you're not going to get a distribution from us, and you're not going to get a tax bill sitting there saying, hey, we made these 3 or 4 trades. Why? Because we can take the ETF and we can create a custom basket swap and push those into the future. And next year, when we make our trades, we can do the same thing again and again and again. And as an active managed ETF, we have a different level of tax efficiency than you would see with an SMA or a mutual fund. So that was number one. Number two is yield. When we started this, the yields were still, a 1-year note was still yielding 10 basis points, right? It was yielding nothing. You go to the bank, say, I want to get a 12-month CD. Great. Here's 5 basis points for the year, right? So you put $1 million in, you get $5,000 on an annual basis. And so what people were doing, they were chasing yield by chasing these very illiquid things like REITs and oil and gas and other quote unquote alternatives, which again, at the end of the day, their biggest problem is liquidity. If anything goes wrong in the plan, then you're stuck and your dollars are stuck there. And by having an ETF, it's not just liquid at the end of the day, it's liquid in the middle of the day. I can put this back on the market at whatever the current price is, and I can get out of it immediately. And so that yield with liquidity was actually one of our big components as well. And then the third one is it's just flat out less expensive. The ETF is half the cost of the mutual fund. And it's a third the cost of to some extent some of the other things that may occur inside of some of the SMAs. And so from that perspective, it's kind of a nice package of all three of these things: yield with liquidity, tax efficient, less expensive, and then again this well managed component of minimizing your volatility. So that's what drove the creation of these two ETFs. Is just trying to respond and do a better job for our advisors and our end clients.
And then the last piece, probably number 5, would be the ability to have gain or grow the account.
Yeah, absolutely. Because TUG is, I mean, that's why it's called tactical unconstrained growth. At the end of the day, even in retirement, if you just say I'm going to take, I've got $1 million, I want a 6% yield from an annuity. That's great, but in 30 years, that $6,000 isn't cutting it anymore. You still need growth plus income. And so the ability to see it grow in value, like we've seen this year, we've paid you 11% year to date, but we still have what? We still have growth in the account in that ETF. That's the combination that everybody needs in retirement. You're exactly right.
All right, Thomas, we appreciate you taking the time today. And I would say to anyone who's on the call, if you do have questions, reach out to your financial advisor. And we'll be able to help you from there. And Thomas, thank you so much for your information today.
You're welcome. I appreciate your flexibility and your adaptability as we've dealt with some technical issues at the beginning.
Thank you, Thomas.
Bye-bye.
Bye-bye.